comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm. Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another episode of State Tax Talks with Joe Tantillo. I'm Joe, your host, and I'm joined here today by a couple familiar faces and one new one. Real quick on the familiar faces, we've got Chris Doyle and Dan Kelly, both old-time friends of the pod. Welcome back, guys.
Thanks.
Hello.
We're also joined today, and this is not only is he a first-time guest, but he is the first-time representative of an entire new area of tax law for the show. We've got Bill Turkovich joining us today, who is the practice group leader for the federal tax practice at Hodgson Russ. Welcome, Bill, and thank you for joining us.
Glad to be here, Joe.
The fact that we're talking about federal taxes right off the bat might make you go, Joe, isn't the show called State Tax Talks? It is, but I'm the host and I can do whatever I want. So what we're going to do today is we're going to be talking about tax considerations for buying and selling a business. And in what world can we talk about tax considerations for buying and selling a business if we don't talk about both the federal and state aspects of tax? Otherwise, we just wouldn't be doing the proper due diligence or giving you fine listeners the information that you need to approach this topic with as educated a view as possible. So that's the high-level topic for today. I'm very excited to have Bill on the show, to have Mr. Doyle on the show, to have Dan on the show. A lot of knowledge in this room right now regarding this topic. So, this came up actually informally recently because we've been seeing more work, especially in the salt space, where people have sold their business and there's some sort of unintended New York tax consequence that arises. But of course, people are buying and selling businesses every day, and they frequently need to be apprised of, what the tax obligations are going to be. With that said, let's start off with just kind of a high-level overview. Value for buyers versus value for sellers. What do we need to be thinking about from each side of the table when approaching? What's the kind of 10,000 foot view on this as we come to the deal table?
Well, I'll jump in on that. From the purchaser's standpoint, I think the proposition is identifying seller's liabilities that could be visited upon the purchaser. For instance, if there are taxes that haven't been paid, not because they filed returns and just forgot to send the check, but because they never filed in the first place. And we see that frequently in the state and local tax space, where people have businesses and the businesses simply don't know that they're liable to taxes in various jurisdictions. So from the purchaser side of the ledger, it is more about identifying potential liabilities that may be hidden liabilities not reflected on the balance sheet of the selling entity.
And how about from the seller side?
I'm going to let Bill cover that because, we want him to talk.
Well, thanks, Chris. Appreciate it. So to me, when I'm talking to both buyers and sellers here, they're somewhat on opposite ends here in terms of tax considerations on a transaction. On the sell side, your goal here is to have as much of the gain on your sale treat as capital gain. Lower rate, have the preference there. That's the focus of most sellers. Whereas on the buy side, you're trying to structure oftentimes the transaction as a deemed asset purchase or a straight asset purchase, primarily to get the tax shield on the deal. So you're looking for amortization deductions, depreciation deductions, so that you're able to capture your purchase price while you're owning the business and not just trying to get a benefit when you exit in the future. So typically, I see buyers and sellers, they're at opposite ends of the spectrum with transactions in terms of how they're structured and the value they're seeing in the deal.
And I'm guessing that the fact that they're coming in from opposite ends creates no difficulty whatsoever throughout the course of the process.
Typically, I would say, Joe, that as on the buy side, I do a lot of buy side work. and having that spelled out in the letter of intent at the outset from a buyer's perspective in terms of how you want that deal structured, whether the tax shield or basis step-up transactions at critical point to you, having that in LOI eliminates a lot of that hand-wringing and fighting down the road from my perspective as you're getting into the transaction.
I should know for our listeners as well, not only will we be talking about federal tax today, we're also obviously talking about some transaction tax topics. So we will, try to provide definitions where we can, but Google is your friend, and so is ChatGPT these days. Very, very useful for figuring out terms. All right, I think that's a good introduction to the value that each side is trying to get as they approach these transactions. Let's talk very basically about purchases of assets versus purchases of stock. Pros and cons of each. Why might one be better than the other? And who wants each?
So in thinking about the pros and cons of an asset purchase versus a stock purchase from the buyer's perspective, Bill just alluded to it. The buyer often wants to acquire the business or acquire the assets in a way that's tax efficient, that provides for amortization or depreciation deductions going forward. It seems to me like, in Bill, you see more of the day-to-day deal work, but probably most buyers, 9 of 10, want to buy the assets because, it's kind of more directly accretive into their business. And you don't necessarily take all the hidden liabilities that may come with stock or that may come with membership units. And so it's not really a tax issue. It can be a tax issue, but fundamentally, a seller would want to sell stock because with that stock goes, in many instances, all of the kind of latent liabilities of the business. There could be employment claims, there could be title issues, there could be tax issues, it could be really any number of things underneath the stock that would become the buyer's obligation if the stock is sold. Subject to typical deal terms and disclosures, indemnifications, clawbacks, escrows, things that maybe would, kind of help the buyer in a stock sale, recover loss. But, kind of the pros and cons, if you can sell stock as a seller, probably overall better and more desirable. If you can buy assets as a buyer, probably better. And so the question of kind of how the deal is structured may come down to, what's the consideration? Are we willing to pay more or less for a certain asset type or acquisition type? I also think about it from the perspective of seeing hybrid deals. Bill mentioned situations of deemed asset sale transactions, and we'll probably talk about those today. Mm-hmm. It's common, I think, to see transactions where you're selling stock or selling membership interest from a non-tax perspective. So for all matters that are unrelated to tax, you're selling the stock, and with it goes the business. But for tax purposes, due to certain structures that are readily available, it's an asset purchase or asset sale. So you have this kind of hybrid treatment where everything non-tax, stock sale. Everything tax, asset sale. And there's kind of, the documents can be drawn up that way, or really kind of whatever way the buyer and seller ultimately agree.
So let me jump in for a second and mention that with an asset sale, there is a tension for the buyer if the assets being purchased are subject to sales tax. Because yes, you want to do an asset purchase to get the basis step up for enhanced amortization and depreciation deductions in the future, but you may have the cost of that may be current sales taxes owed on the purchase of the assets. Many states have an occasional or casual sales exemption that applies when you're selling assets in bulk, but New York State doesn't have that. So if you're buying, particularly a service business that's got a lot of computers and a lot of desks and other FF&E, you could end up having, a big sales tax bill as part of that transaction.
Yeah, and just to add in here too, I think kind of optimal situation for a lot of buyers, absence, massive latent liability, is to do a deemed asset acquisition where for corporate purposes, you're buying, membership interest in a limited liability company, but for tax purposes, it's treated as a deemed asset acquisition. It avoids a lot of the issues with sales tax that Chris mentioned there, and it's also a lot simpler from a transaction perspective because effectively all you're acquiring is membership interest, for example, in a limited liability company. You're not having to have your corporate team go out there and chase every contract, make sure you're capturing that you would have to do if you're doing a pure asset deal. So I think in the current marketplace, from a buyer's perspective, being able to do a transaction that is a deemed asset acquisition, but an equity acquisition for corporate purposes is the best of both worlds for them. But a seller, I think a lot of times is viewing that, as we mentioned earlier, somewhat of an opposite direction. A lot of those structures that enable a buyer to have a deemed asset purchase causes a seller who otherwise was hopeful, hey, I'm going to get capital gain on this transaction. They might have some ordinary income. And that's where you end up with situations where you have buyers and sellers negotiating about a tax gross up, effectively to make the seller tax neutral, as though they had sold stock. They get a little bit extra of a payment from buyer, so buyer gets their tax shield on the deal they want. Seller gets their capital gain treatment or net effective capital gain treatment. I think that's really a very common outcome in a lot of transactions.
But with that, you get a state and local income tax issue, because if your seller that's selling interests is in Florida, for instance, we're going to find out not all, but most sales of interests will not only attract capital gains rates, favorable capital gains rates federally, but also won't be taxed at all by the states in which the business may be operating. Florida is a no income tax state. However, if it's a deemed asset sale, then all of that income that's recognized is going to flow through the entity, and a large potential for state taxation that will be treated as business income, taxable wherever the business is operating.
We'll come back to that point more later on in the discussion, because there's some funky stuff going on in New York, particularly right now, that relates to I want to back up for a second, and because I have some specific questions for Mr. Turkovich in this regard, mostly because I'm not in the deal room every day. And would you call yourself a transaction attorney, Bill? Is that
predominantly a transactional tax attorney?
So as I was thinking about this topic and preparing for the show, I was wondering at a very basic level, how long before these deals are people coming to you or coming to the other, attorneys on the deal team to start to think about, these kinds of considerations? Is this something, I have a bullet on my outline here that says, consideration related to entity selection and taxation thereof. Like, is anybody ever coming to you in the early stages of forming the business and going, we want to prepare for a sale 10, 15 years down the line? How should we structure the business to begin with? Or is it something that's happening, once the sale is already kind of starting to come into formation? I imagine the answer is it depends, but I'm very curious.
I would say it depends. A lot of times at early stages, they're focused, owners are focused on what is going to be the current tax hit of the structure that I have. If I have an S corporation, a partnership, or an LLC tax as a partnership, I'm focused on one layer tax. Things are going to flow through to me. Early years produce losses. That to me is the focus. I don't necessarily see a focus on the back end of, in 10 to 15 years, what is the sale going to look like for us?
Right.
I think the caveat there, though, is following the TCJA enactment in 2018, there was a big focus on an old code section that was in place since 1993 that really a lot of people didn't focus on. It's called 1202, or qualified small business stock. And that effectively allows, subject to a bunch of hoops, that if you operate as a C corporation, meet all those other requirements, you could potentially on an exit have a capital gain free transaction or reduced capital gain transaction where you're able to effectively exclude gain up to a certain limit. That was post 2018. We've had a lot of conversations from businesses that are starting about whether they're going to start as a C corporation, which was a drastic departure from conversations we previously had with clients. I think C corps are a little bit more in vogue now. And by C corp, meaning that the entity is going to pay tax at the federal level, and presumably most states are going to respect that as well, if not all, where the entity is going to pay tax. That's been a big shift of talking from kind of a purely domestic standpoint of utilizing C corporations because of this potential qualified small business stock or 1202 exclusion on a potential disposition. But it's also coupled with the reduced federal rate that came into play for corporations in 2018, down to 21% from 35%. So the operational period that you're a C corporation, it's obviously a lot better than it used to be, being down from 35 to 21, which coupled with a 1202, if they're eligible for it, that's made C corporations a lot more attractive, Joe. But I would say the majority of folks aren't coming to us thinking how, aside from that specific scenario,
Right.
Most folks are not thinking, what is this going to look like for me on an exit? A lot of them are like, I formed an LLC. It's me and my buddy Joe here. Should we be an S corp or a partnership? And they're focused on, hey, is there anything I can do with self-employment tax if I'm an S corporation? Or they talk to someone like Chris who's talking about different apportionment rules. To me, that's more of the focus in the early stages than what does an exit look like.
We could definitely do probably a whole series on entity selection and various.
Could talk for hours on that, Joe.
But I thought it was a relevant point to bring up in this discussion, and it leads me directly into my next point, which is something that Chris and I talked briefly about yesterday. Let's talk about restructuring of ownership in expectation of a transaction.
So there are upsides and downsides depending on what type of entity you have. If you're operating as an S corporation, I'm wondering if we are rolling right into the F-Reorg issue right now.
We probably are. Somebody structured this outline pretty well, I think.
I think Bill or Dan might be more expert to talk about such things. But if you're in an S corporation, notwithstanding Bill's assertion that there's more discussion about purchasing as C corporation stock or forming a business as a C corporation, most purchasers are trying to get either a partnership form or a disregarded entity form. So they want to purchase from an LLC. And if the business that is the selling business is operated as an S corporation, you have to somehow get that business into a LLC structure to facilitate the sale because the purchasers want to buy LLC interests. The mechanism for that is a little convoluted, and I'll let Dan or Bill jump on that grenade.
So just to back up, just to kind of lay a little bit of groundwork here. So S corporations are a little bit of a funky vehicle, right? You have pass-through taxation for income tax purposes, but they're also subject to a lot of C corporation rules. And they don't exactly mirror how partnerships are treated on their Internal Revenue Code. So for a buyer, and they're approaching a target that's an S corporation, they simply buy the stock, they have everything they paid for that effectively trapped in basis. There's no equivalent of a 754 election that exists in the partnership space for S corporations. So that's a pretty raw deal for a buyer that they're going to have everything they paid for basically trapped in the stock, that they're really not getting a tax benefit for that until they dispose it in the future. So a big goal from a buyer of an S corporation, as Chris mentioned, is to cause that S corporation to either agree to make a certain election, known as a 338 election, H10 election, or two, engage in an F-reorganization prior to the sale, which results in the target becoming a disregarded entity that the buyer will purchase. One of those two options is a great deal for a buyer here because they're getting that end result that Chris alluded to. They're getting a deemed asset purchase. I think historically, 338 H10s, Chris, from your years of experience, that was the way to do this. From corporate purposes, the buyer just buys the stock. Buyer and seller agree to file this election with the IRS, and buyer gets their great deemed asset sale. Problem with H10s, which I think for a lot of our transactions have fallen out of vogue, is in order to have a good 338 H10, that S election for the target's got to be valid. And folks who deal with S corporations, there are a lot of pitfalls that folks encounter dealing with them. And I think a lot of practitioners believe, is there really a truly valid S corporation out there? So that's a lot of risk to a buyer if they're relying upon an H10. If that S is bad, they're going to be chasing an indemnity with the seller here to get the tax benefit they thought they were going to get on the transaction, which has led to the proliferation of F-Reorganizations. And most folks might think of Fs as, hey, I'm going to take my New York corp, move it to Florida, that's an F. The F we're talking about here is very similar, but it's a little bit more complicated. So effectively, the IRS came out with a piece of guidance over a decade ago that blessed these quote-unquote F-reorganizations for S corporations. In very simple terms to me, the owners of the target S corporation create a new holdco. they contribute their stock of target to that new holdco, make what's referred to as a qualified subchapter S subsidiary election, basically causes the target to become a disregarded entity. And then depending on what state they're in, the last step there is, if we're in New York, we got to merge that into an LLC. If we're in a formless conversion state, they can just file with their Secretary of State to convert it. Or sometimes you have a unique scenario where the historic company is an LLC that made an S election. You may be able to just file a form with the IRS to make it disregarded. So at the end of the day, all of those words that I just said result in basically a holdco with a disregarded entity underneath of it, and buyer buys that disregarded entity from the new holding company.
This is one of those moments when I'm thinking about when we have video podcasting in the future. We could have showed all of the various slides and the step chart for the F-Reorganization. This is one of those things that the first time that Chris ever explained it to me, I sat down in his office and he immediately went to the whiteboard to draw it out.
Got to get a copy of my slide deck, Joe.
You've got a good slide deck.
I
too.
got a great. You just got it for this.
Yeah.
That thing has been. that thing has got some mileage out of it.
For those of you out there though who do not have access to Bill's slide deck or Chris's whiteboard, that was a very good explanation of how this works in word form. So hopefully you can, maybe listen to it 2-3 times and you should be able to follow. Okay. Picking back up. F-Reorganizations, generally speaking, sometimes I like to talk about the history and the policy on the show and not just the actual mechanics. Is this something that somebody just figured out was in the code? Like they figured out how to do it based on combining various provisions? Or is this something that was actually they legislated for this? And it's okay if we don't know that answer.
Well, the S corporation thing is an afterthought. I don't think anybody was thinking about S corporations when the reorganization provisions that are in 368 of the Internal Revenue Code included A through F, A, which is a statutory merger, and F, which is the so-called mere change of form. I don't think that they were thinking of S corporations then. And even as recently as 10 years ago, before they had qualified subchapter S subsidiaries, I don't think that S corporations would have done this form of F-Reorganizations. They could reincorporate in a different state and get, that form of F-Reorganization. But this was something new that came in once there were the possibility of having a corporation owned by an S corporation where the owned corporation was disregarded. That didn't exist always.
Right.
And now that it does, you don't have to, but it's convenient to have this form of reorganization available so that buyers can buy ownership interest in an LLC. And that's the driver here, I think.
And what's the seller's benefit, if any? Why agree to the F-Reorg?
The seller's benefit is they get to do the sale. I think,
right.
That's more
the buyer agrees.
The buyer doesn't want to buy. The buyer either wants the business as a whole unit to avoid the contractual issues that Bill already mentioned, mm-hmm. and doesn't want to do an asset sale because of that, and at the same time gets the basis step up because it's treated as an asset purchase for income tax purposes, even though it's a business entity purchase for income tax purposes. I think that the seller's benefit is they get to do the sale.
Yeah, and I would say too, they might, and we've seen situations where if there's an ability to do a basis step-up transaction for a buyer, that's going to drive a price higher because the buyer is going to be able to recapture some of that capital outlay at the outset and get it back ratably through amortization or depreciation, especially in an equipment, say, heavy business where there's going to be potential for bonus depreciation. That, I think, is a good thing from a price-driving perspective for a seller. And also, Chris, I think as we've seen, this is a new post-2018 reason is PTAT, or pass-through entity tax elections. That can, as we've seen, cause situations where normally a seller is going to have more tax following an F-Reorganization because they're going to have some of the gain tax as ordinary income. If pass-through entity tax elections in place, that might allow them a deduction for the state tax paid on the deal, which they might not be in a spot where they are owed a gross up by a buyer. They might be in a better position paying less tax overall than if they sold stock. So to me, these days, I think PTET is one of the big drivers of, if I'm a seller, I'm agreeing to this, I'm taking that into consideration.
I was just going to make 2 points on that. One's really a question, Bill. This is probably more for our corporate colleagues, but today, folks coming to us to think about how to form a new entity, out of the pie of 100%, what percentage go S corporation? I mean, there's certain reasons, perhaps with respect to certain types of companies or businesses, but out of every 10 companies established, how many elect S status?
I would say I probably have bad data on that because, typically the folks that are coming to us for the initial formation are what I would call cross-border international clients. Mm-hmm. So the considerations there are completely different. So I can't say that I have a really good kind of standard or data points to opine on typical domestic businesses there. I think S corps are still really commonly used. While we might not do the formation, we see a ton of them. And I think that's because folks have a flexible view of the self-employment tax benefit that S corporations provide versus a disregarded entity or a partnership.
And folks, that's the difference between Hodgson Russ's federal tax group and the state and local tax group. The state and local tax group has no hesitation to give an opinion even though they have no facts.
And then I guess the last piece about that, by the way, I haven't called Bill in about 15 years, just Turk, exclusively Turk. So
yeah, I wasn't. I should have asked if you were. Good
it's fine, Dan.
This is weird. We're being so.
Dan and I are law school classmates, so this is it's a long-standing chatter about these topics going back to our law school days.
Fun fact for the listeners: we all have nicknames. Dan's got sunglasses on right now. He's got a secret jazz band that I've just learned about. There's a lot going on behind the scenes here.
That's a different podcast for those facts. But and the other, I guess, part about that is, I think a point Bill mentioned earlier, some S corporations are legacy businesses from some time ago when they were formed, and that's the question of, is there a valid S election? And then the PTET piece of it, I think that maybe coincides closely with the residency status of the owners of the business. And, kind of if you lived in New York, for example, it may be more beneficial to have the asset sale and to generate the PTET, kind of at the entity level that then reduces your net effective tax rate. Mm-hmm. But if you lived in Florida, and depending on the allocation percentages of the companies, that might shift in a different direction, just kind of deal to deal, transaction to transaction. But, Bill's exactly right. That's super interesting as a something that didn't really exist before the TCJA, and the different rules that flowed out of it and the different state approaches to the pass-through entity taxes, including with as noted, just the F-Reorganizations and kind of continuation of PTET within entity types. If it's just a mere reorganization or a mere change of form, often it can be kind of continued from the S corp into the operating LLC. Kind of something to review state by state.
All right. We're going to take a pause here. A lot of good points being made, a lot of interesting information, but we are out of time. So we're going to pick up this conversation in part 2 of this series on tax considerations for buying and selling a business. Until then, this is State Tax Talks. I'm Joe Tantillo. We'll see you real soon. Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.